Welcome to OCBC Credit Research Insights. We are glad to have with us today Anuj Awasthi, Vice President of Operations at the Credit Guarantee and Investment Facility, CGIF, a trust fund of the Asian Development Bank. He looks after the day-to-day operations of the CGIF. Previously, Anuj spent more than 20 years in the banking sector with a focus on local currency financing solutions. What is the CGIF? What do you mean by a trust fund of the Asian Development Bank?
So CGIF stands for Credit Guarantee and Investment Facility. We've been set up by the 10 ASEAN member countries, China, Japan, Korea, and the ADB. ADB is a trustee of CGIF. It means CGIF does not have an independent legal structure. We adopt all the legal structure under the ADB. Our business operations are governed by ADB as a trustee. And all the funds which have been given to us are managed by ADB as a trustee of CGIF. We are very close to ADB in our operational significance from that point of view, and even our legal structure is akin to what ADB is. So we carry all the privileges and immunities when we conduct businesses, as all ADB staff does.
I see, understand. So the ADB has actually been around since the 1960s, but the CGIF was set up in 2010. Were there any particular event that was happening at that time that led to the ADB to decide that it needed to set up a credit guarantee arm?
So ADB did not unilaterally decide to set up CGIF. The decision to set up CGIF was thought as a response to the Asian financial crisis of 97-98, where a lot of corporates and the general economy suffered a lot because a huge amount of borrowing, especially long-term borrowings, were done through the hard currency markets and not in local currency. So when the currency is depreciated, it had a huge negative impact on the balance sheets of these corporates. At that point in time, something called the Asian Bond Market Initiative started, which was an ASEAN +3 initiative, +3 being China, Japan, Korea. It was thought that an institution needs to be set up which focuses on providing alternative financing routes in local currency to companies which are looking to grow in the ASEAN region. And that's where CGIF came up. Like I said, it was a trust fund of the ADB. Our operations have the same privileges and immunities as a multilateral development institution has. So all the 13 governments, along with ADB, have given us some capital. It took about 10 years, which, if you ask me, is relatively fast for 14 governments and ADB to get together and set us up.
Today, then, what role does the CGIF play in developing local bond markets?
So we are a pure play guarantor. So if you look at our name, it's Credit Guarantee and Investment Facility. To be honest, we are hoping we start the investment facility part, but as of now, we've not. So what we do is we just guarantee bonds for issuance in local currency. We cannot do anything in hard currency, and local currency is defined as any currency of our contributor states. Our goal is very simple, that companies should be able to match their assets and liabilities when it comes to the revenue mix and the borrowing mix, and that's where we come in. And we believe that over-dependence on bank loans may not be able to give the balance sheets the right kind of capital structure, especially if people are desirous of getting longer-term financing. Bullet financing in nature is very difficult to get through the banking sector per se. So that's why CGIF is actually acting as a catalyst, where through our guarantees, because we are rated quite high, we are able to bridge the gap between the investors and the issuers. So one of our primary goals is to increase supply and get more issuers socialize with the capital markets over here. Be aware of the fact that there is depth in the local currency investor base. There is demand for good credits, and if companies are doing well, why should they not be taken to the capital markets? And that's the goal with which we work.
Just now you alluded to it already, but maybe you can share with us a little bit more details about why is it really quite important for companies to have local currency debt?
Yeah, so when companies overtly borrow in hard currency, they get a lot of currency risk along with it. Say, let's take for example, say in Indonesia, if they've got dollar earnings and they're borrowing dollars, then they're hedged on the currency side. But then if a company says, I want to borrow in yen because I can get 10-year monies from there through a call spread, which is not a hedge, it is a partial hedge, it does import some kind of currency risk onto the balance sheet and also the economy, because if the currency depreciates, it is detrimental for both. We've seen in the past a lot of examples, because those companies have already, a lot of companies suffered because of it. If you can actually give viable alternatives for companies to borrow in the currency where they are spending and where the revenue streams are coming, it creates a natural hedge on the balance sheet and the operations are more stable. Say Vietnam. where when we actually entered into the market for the first time in 2014, it was very unique because there we were looking at companies which were desirous of getting long-term debt financing, but they didn't have avenues either to raise money in dollars or in VND locally. With CGIF's intervention, we were able to get a few good companies, 10-year money from the VND local market. If there is a project, if the balance sheet can justify the need for longer-term financing, CGIF would be very happy to go and support that issuances, and investors, because of our credit strength and support and even our due diligence processes, have the confidence that if CGIF is supporting, the deal would be a decent deal to invest in.
I guess then even if there is a need to use hard currency, at least in terms of proportion, they can still consider.
So there are companies which need hard currency. We know the ASEAN region very well by now because we've been working for 15 years. So again, taking examples of countries like Indonesia, if you have a PPA with PLN, it is dollar indexed. Typically, if a company actually borrows in dollars for that, it makes sense because then their earning stream is also indexed to dollars. But if you go down across the borders to say Thailand or to Vietnam, the PPAs are all local currency. So it makes more sense to have longer term financing if you have project finance deals in local currency. Otherwise, you're exposing yourself to movement on the currencies. In a region where currencies usually tend to depreciate, and I'm not saying they'll always depreciate, but if you see historically, currencies have been depreciating. If you borrow dollars and have earnings in local currency, it can be detrimental to your future earnings. So that's something which we do not propagate, and that's precisely why CGIF was set up.
So maybe since we have the expert here, maybe you can explain to us the main types of credit enhancements.
We are very simple. See, the thing is, the word credit enhancement has been abused, has been spoiled a bit by certain past behaviors in the market. So CGIF has kept it very simple. We guarantee all risks, non-payment events. We do not ask why the non-payment event has happened. We do not want anyone to justify to us why the non-payment event has happened. It could have happened because of non-performance of the company, mismatch in cash flows, certain legal issues, a TNC risk which is imposed. We don't care about it. If the investor does not get the money, we pay. And then we recover from the company because we have bilateral agreements. Our guarantees are unconditional, irrevocable. We are there to bridge the gap between the issuers and the investors. So we try to keep it very simple, and that's why we say our guarantees are a guarantee for non-payment events. If you do not get the coupon, the principal CGIF will pay.
I see. So it doesn't cover things like technical breaches and then the bondholders accelerate, so it doesn't, okay, it's the non-payment.
How we structure our deals, because of this unconditional, irrevocable nature, CGIF retains the right to accelerate. If the bondholders accelerate, our guarantee falls off. And then the reason we do that is for two reasons, because we are the ones who are holding the main risk on the credit. Yeah, we are the ones who are taking the whole credit risk on the underlying. So from our perspective, we also are aware what the reasons could be in diverse geographies. If we believe something is happening because of TNC risk and is temporary, and there's a default on the coupon because of that, we may choose not to accelerate if we think it's a temporary phenomenon. If we believe something has happened because of a mismatch in certain cash flows but will rectify within 2 months' time, and possibly an acceleration from our side will be more detrimental to the company because it may trigger cross defaults across the board, we may choose not to accelerate because if it's a temporary thing. But more often than not, if we believe the company is not doing well, and we will choose to accelerate, and then we'll bilaterally tend to recover from the company.
I see. So the bondholders give up their right to accelerate, and it falls.
In all our deals, CGIF retains the right to accelerate.